We'll start. Thanks very much, everybody. Good afternoon and welcome to the Australian Pavilion for a discussion around blended finance in the Indo-Pacific and Southeast Asia region. My name is Kate Rogers and I am the Assistant Secretary in the Department of Foreign Affairs and Trade that has responsibility for climate finance, amongst other things. I'm thrilled to be introducing the session this afternoon. This is a topic that I'm deeply interested in, so much so that I read the State of Blended Finance report on the flight over. And I wanted to congratulate Convergence on the report. For me, the report picks up on some critical points, maybe showing my colours here as an economist. I thought there was a really nice encapsulation of the macroeconomic challenges that are currently facing the region and that we hear so much about. So high inflation, aggressive monetary policy by developed countries and the impact that has on emerging markets, capital outflows, the currency depreciation, debt levels, the servicing impacts around that, higher prices and the balance of payments impacts of food, fuel, fertiliser, including as a result of Russia's illegal invasion of Ukraine, plus pressure on donor budgets for ODA, particularly the humanitarian budget. So there's a lot going on and it makes it a very difficult environment for blended finance and for many other kinds of finance. And yet the challenge that we face is enormous. So the report also cites a 2021 report from the International Energy Agency that states that there'll need to be over $1 trillion annually invested in emerging markets through 2030 to 2050. This is not an insignificant amount. And that's what is needed to get them tracking towards net zero by 2050. The report also flags that financial flows from the private sector are declining, with concessional flows for blended finance stagnating since 2017. And this for me is a major problem. It just flies in the face of what is needed. As we all know, we need financing from all sources in order to address the challenges that we face. There was a great quote in the report that resonated for me, and I think Joan and I have actually discussed this when we met, although you may not remember. I think it's a quote from a BlackRock report. Does that sound right? Where it states that public finance has been too focused on individual deals and not mitigating the risk more broadly. I couldn't agree with that more. This is just something that, we're always chasing the pilot or the deal in the expectation that suddenly it will unlock broader flows, but that doesn't seem to have happened. And we haven't tackled the systemic kind of changes that need to happen to really take this to scale. So I'm hoping that some of the discussion this afternoon will get to that point. Blended finance is critically important for us in trying to help unlock this, but I think the challenge is taking it from exemplar projects and pilots and little wins into something that is much bigger and connecting it. Obviously, it's so important that blended finance is well targeted, that it provides financial and development additionality, and that's one of the really excellent things about blended finance, that we wouldn't be doing it unless it did provide additionality, both for finance and for development impact. And of course, we all hope that one day it won't be necessary. So our panellists today will dig into some of the issues I've just raised, I hope. I'm sure you will. And I'm really looking forward to hearing what they have to say. So I'm now going to hand over to Joan, who is the CEO of Convergence, to run the panel. Thanks very much.
Is this still on? Thank you very much, Kate, for your remarks. And for those of you who want to read the State of Blended Finance, it's on our website for free at www.convergence.finance. What I thought we would do with the structure of our panel today is that I will first introduce our panelists. Then I'd like to run through a quick review of the State of Blended Finance as it pertains to the Asia Indo-Pacific region. Just give you some statistics that boil it down to one particular region of interest. Because the subject that we will take the panel discussion through is the State of Blended Finance or outlook for blended finance in this specific region. We have a wonderful crew of panelists. We are short one because he didn't get his Blue Zone pass. So I will try to describe CSEF on behalf of Climb Capital. Our remaining panelists, and I will point out that it is an all-female panel, not by design. Women are finding our seat at the table. We have from your left to your right, Kitty Boo of the Global Energy Alliance for People and Planet, Laurie Kerr of FinDev Canada, and Dana Barsky of Standard Chartered. So a rock star panel, even if we're short one. Let me go ahead and walk you through first a little bit of information as a backdrop. So we will have a panel for about half an hour, and then we would love it if any of you would like to ask some questions and direct the conversation in any direction you'd like to take it. I thought I'd give you a quick sketch of what blended finance looks like in Asia. So our State of Blended Finance report for the second year in a row covered climate very intensely. But let me back up the screen by one and talk to you first about the entire field of blended finance. It's operating at about $14 billion of transactions per year. However, the past year was a light year. In other words, the volume of finance, the number of deals are going down. If you look at Asia specifically, we are actually seeing growth in the past few years in the overall blended finance market, even if the entire field is not growing that much. So we know over time of about 300 transactions that we have verified are blended and have happened in the Asia region. I'm including South Asia, Southeast Asia, East Asia, and Pacific. That entire group of transactions that we've recorded is about $60 billion worth of deals. Of that group, only about 151 were, as far as we could tell, directly involved in climate finance. The others are, you can imagine, health, education, or whatnot. The total amount of climate blended finance in the region over the past few years is $34 billion. If you look at where the money is going in blended finance, it is going first to India. There are 115 deals that happened in India. You can imagine why. It's a large economy. And it's a poor country, and so you can imagine why there's an intersection between philanthropic or ODA money and commercial capital. The second most frequent destination for transactions is Indonesia. We saw 46 deals there, followed by Vietnam and the Philippines with 35 and 33 transactions. So you can picture that the investment field of blended finance in Asia largely mimics the overall investment patterns of commercial investors in the region. The pattern in Asia is largely the same as the pattern if you look across the world. First of all, 2/3 of the transactions we see are using concessional money inside the capital stack of the structure. So it's not technical assistance money, it's not project development money, it's not a guarantee, it's actually money inserted in between the equity and the debt that are on commercial terms in the transaction. So 2/3 of the time, that's what we're seeing. That's why we are considering it blended, is because we're seeing concessional and commercial capital merging inside a transaction. We see two bunches of data. That is, if you look at the size of transactions, there are a lot in the $25 to $50 million range and a lot in the $100 to $250 million range. Respectively, each of those is about 20% of the total deal volume. Most transactions cover energy and financial sector. Financial sector, by the way, is a catch-all because you can be investing in a bank and that bank can be doing climate transactions. So when you see financial sector, sometimes it's very hard to see what's underneath that. The differences between Southeast Asia, Indo-Pacific, and the rest of the world are, first of all, that we see that projects and funds show up equally frequently and less than climate finance, climate blended finance overall. So if you go to our State of Blended Finance report, you'll see that climate blended finance is about 40% of it is in the shape of a project. By project, I'm talking about a site-specific investment like building a solar field or a water treatment plant. So in Asia, it's only about 20%. Sorry, let me make sure I got that right. Yes, it's about 28% are projects and 29% are in the shape of funds. A fund could be a private equity fund or a debt fund. So there's a little bit of a difference. There's less frequency of projects than across the world, and we're going to be talking about projects in today's panel. Also you see fewer climate transactions in the blended field that have as their ultimate beneficiary smallholder farmers. Remember, blended finance happens a lot in Africa. In sub-Saharan Africa, there is a fair prevalence of donor money meeting commercial money in the ag space. So it kind of makes sense that in Asia that is a slightly less predominant pattern, although there's perhaps a lot of opportunity there to grow out blended finance. I want to give you 3 examples of very interesting early stage operating blended finance vehicles that perhaps can be a basis for the conversation here. First of all, on behalf of Mason, who was supposed to be here for Climb Capital, talking about CSEF. CSEF is a really interesting structure that's totally a donor-funded pool, and it goes and invests in early-stage renewables transactions around Southeast Asia. So CSEF stands for Southeast Asia Clean Energy Fund. So it's a totally donor pool, but they're inviting in early-stage renewables deals at the development stage and the construction stage. And with their money, they are mobilizing private sector money to come in behind them into those projects. So that's one really interesting feature. And I think they're mobilizing about $27 of private money, commercial money, for every $1 they've put in a renewable energy transaction in Asia. I believe they're now working on CSEF 2. So this is Climb Capital's deal. So Mason would have talked a little bit about that had he been here, so I wanted to make sure that we covered that. 2 more interesting examples of blended vehicles that are working in the early stage build-out of projects in the region. First of all, Power Trust. This is a concept, it hasn't happened yet. It's a concept that we Convergence have put a grant behind to try to develop. Our grant, in turn, was funded by the Australian government, so I thought it was a good one to mention here. What Power Trust is trying to do is to pre-finance renewables projects by paying forward for the renewable energy credits that may be generated by those projects, and then hopefully selling those renewable energy credits on down the line. Because one of the biggest problems that clean energy developers have is they don't have equity. They maybe can do one deal at a time and flip it and only take the proceeds to do the next deal. So Power Trust for us is an interesting structure and worth helping along. And finally, there is something that the Australian government has been doing with, I believe, Sarona, which is a fund manager, an impact fund manager, which is EMIF, which is the Emerging Markets Infrastructure Fund. Yes, so in their most recent development review, Australia has decided to take this vehicle, which is, again, investing in the development of renewables transactions. They're trying to take this structure and blow it up from $40 million to about 250 million Australian dollars. So it was successful in pilot stage, and they are growing it. So there are 3 examples. There's CSEF, Power Trust, and EMIF of actual structures on the ground that are blended or promoting blended transactions that are hopeful data points for you. All right, so I want to get off the podium, go over to my panel. And hopefully this is on. Is this on? Okay, great. You can all hear me, right? Super. Okay. I want to start. I want to start with GAP, actually, if I could. Again, Kitty represents the Global Energy Alliance for People and Planet. GAP is a initiative backed by Rockefeller, IKEA Foundation, and the Bezos Earth Fund. And I think you're capitalized at, what, 1.5 billion? Is that right? And it's a totally philanthropic effort, but doing a lot of blended finance. So one of the things I wanted you to explain is the breadth of your activities. You're not just doing transactions. And Kate was talking about the policy changes and the environmental changes that are needed for blended finance to work. Maybe you could tell us a little bit about what GEP is doing in the ecosystem space, and also what you're doing with early stage project developers. Maybe take those two subjects.
Thank you, Joan. Hi, everyone. Good to see you here. So maybe let me begin by saying that the way that we come in is actually reflected in the way that we organize the seating chart today. We've got Joan there providing market intel, the important trends, and the analysis, the big direction. And you've got me as a philanthropic capital coming in, who is the most risk tolerant. Then you've got Laurie as well as Dana. So I think this is the lineup for you. But the point I want to make here is we need to work together. This is a very powerful women panel, which I'm very, very proud of today. But GAB, as Joan mentioned earlier, is a philanthropic organization. And we're born to creation in order to bring the energy access and prosperity into emerging markets. So in Southeast Asia, we do have deep dive markets in Indonesia, in Philippines, and we work in multiple markets. In doing so, GAP stands on two legs. On one hand, we work with policymakers to enable policy shaping and forming to allow the financing, to allow the tools like a powerful tool like blended finance to come into shape. So that's an enabling environment. On the other hand, we do invest in deals and we invest in blended finance platforms. I can get into that a little bit, but the idea is for GAP, given the high tolerance of the capital, we are very comfortable getting into deals or platform using our capital in different ways. So we can do grants, returnable grants, concessional, deep concessional loans, as well as direct investment in equity. So with that high level of risk tolerance, what we aim to do is within the energy transition in the region, what are the projects that need to happen which otherwise wouldn't have happened without GAP capital? So our additionality is very much measured. The other thing is GAP as a philanthropic organization is very much in sort of in the in-between space. So it's the segment of philanthropic money that's moving into blended finance. And we thrive to be as self-disciplined as we can when we move into the financial market by self-regulating and using a very rigorous impact measurement lens to look at every decision we make, every decision and the impact it brings into the market. So with that, I would say we've done some of the deals investment. When you do deals, the issue is you do it one by one. And you do one deal that easily take up to 1 year, 2 years, and you move on to the next one. On top of that, it's another 1 to 2 years. So the aggregation model came in the region where we're thinking about what would be the right tool to bring into the market and really reach that kind of impact and that speed that we need to see in the market. And that's aggregation of demands, aggregation of deals, projects, pipeline, as well as a bit of an aggregation of credit. So that's why we also invest in the blended finance platforms and so on. So what I will wrap up by saying is now, in Southeast Asia, we need more than $9 trillion every year to 2050, according to the recent report, in order to reach the targets. But we do have countries, 8 out of 10 Southeastern Asian countries have decarbonization and net zero goals. So the ambitions are there. Where does the money come from? Whenever I engage with policymakers, they're worried they will be paying for a higher development cost. And they will also be paying for a climate catastrophe if we don't keep things under control. And they're worried about losing in two sense. losing in the energy transition because you will lose a lot of jobs. That's the just piece. You will also be losing to the global north in the sense that all the jobs, technology, financing will be staying above the equator in the north. So with that, I conclude by saying blended finance is a very, very powerful tool. And I really look forward to working in partnership with everyone and also looking to bring in more philanthropic players in this space.
Just, if I could just ask you to dig into one of the points you just made a little bit more deeply. We need many more transactions to be brought up to a commercially investable stage. And obviously, if large pools of capital like GAP go chasing one $5 million small renewables deal at a time, we're never going to get there. So when is it that GAP chooses to work on a project, and when is it that you choose to work on a platform like EMIF, like Power Trust, like something else that reaches many projects? How do you make that decision, and how do you help us stay on a good pace?
I think that's a great question. Sometimes when we choose to work on a single project, there are several pieces that goes into the thinking. Number one is there hasn't been anything like this in the market. We need the innovation, the testing, and the learning of a business model. So by moving into the first case, we do a number of things, one of which is seeing is believing. We're going to use this case and demonstrate to the market that this can be done and this is possible. The second thing that we do is we then use this as a case study and we distill the learning within ourselves and we share with the partners. What have we learned from the single case studies? The third thing is, with this, you start bumping into bottlenecks. You start noticing what is the bottleneck when it particularly comes to the policy framework. And that informs the policy piece. So that's when I think the single projects are very, very important. However, moving onto a platform, that's really interesting as well, because in that process, all of our learning, project pipeline, our expertise in the different areas, different jurisdictions will come in. However, that's when we can really also raise the ambition with development agencies, with development banks, with other commercial capital. So there are trillions of dollars sitting with GFANs waiting to be deployed. And yet there is a perception of risk of the market, of the country that you're ready to move in, and of renewable projects. So with the GAP learning, we're hoping to really build a platform approach in which the pipelines will be brought in, and then the perception of risk can change. Similarly, the safe environment for investment, that sometimes is a reality, but sometimes is a perception. What is risky and what is safe over a longer term transition finance? So I would stop there.
Thank you. So if it's a small transaction, it has to justify the effort by having huge demonstration and piloting effects. And then the larger transactions are things that you can tee up for other large development banks or investors. Interesting. Okay, Lori, so you run a development bank. Development banks cannot operate in the red. You need to actually take risks where you think you are going to be compensated for those risks, even though you too are in the demonstration game. You have a different appetite for risk. Unlike GAP, you can't put in a grant and accept that you don't get money back. So that does limit what you can look at. And as Kitty said, there's a spectrum of capital sitting here, right? So tell us where the difference is between what a development bank like FinDev needs to look for as opposed to something like GAP, and what it is you're planning to do in this region in particular.
Thanks so much, Joan, and it's a pleasure to be here. So just very quickly, for those of you who may not know FinDev Canada, because we are about to embark in the Asia region, where Canada's DFI, as Joan had said, providing financing, investment, blended finance solutions, technical assistance, and knowledge to support sustainable and inclusive growth aligned with the SDGs in Paris. We work in 3 different sectors: sustainable infrastructure, the financial sector, and agribusiness, forestry, and their value chains. As a DFI, we look through 3 impact lenses. The first is climate and nature action, and I would mention that we're the first DFI to actually include nature specifically as one of our impact goals. So climate and nature action, gender equality, women's economic empowerment, and market development. So when we make our capital allocation decisions, those are the 3 that we're looking for. Heretofore, we've been working in Latin America, the Caribbean, and Sub-Saharan Africa, and we just got the mandate to expand into what Canada calls the Indo-Pacific region. So very, very excited about all the opportunities in the region, and we'll be sort of putting boots on the ground next year. So having said that, back to your question, Joan, where do we sort of fit in this broader ecosystem? So indeed, we have a dual mandate of being financially self-sustaining and having development impact. So again, we use that impact lens through all of our decision making, and we need to make sure that we're making investment decisions that are going to be financially sustainable, so that we're not continually going back to our sole shareholder, which is the Canadian government, for additional capital time and time again. So we're trying to make a return to invest that back into our operations. Having said that, what makes us different and where we sit in the ecosystem as a DFI is we're a bridge between more traditional aid from public sector and commercial and private investment. So it's kind of perfect that I'm actually sitting here. So how are we different? One is that we do have a higher risk appetite than the private sector, so that is mandated. So we do have a higher risk tolerance. And secondly is that unlike much of the private sector, we invest in emerging markets 24 hours a day, 7 days a week, so we know emerging markets. So going to what Kitty said in terms of some of the perceived risks, we partner with the private sector. This is what we do all day long, so we're able to sort of bridge those enormous information asymmetries that the traditional private sector has about the risk and return in emerging markets. Having said that, again, we're able to take more risks. We invest in emerging markets all day long. However, we can't do it alone, and this is why blended finance is actually part of our toolkit. It actually helps. It's a double whammy when we use concessional finance. Currently, we're managing some concessional finance on behalf of Global Affairs Canada, the Canadian government. That does two things. One, it actually helps unlock our own balance sheet, again, because we have a higher risk tolerance, but we do price risk. And secondly, then, it helps us even more to unlock private capital. So it's a double positive whammy, as I like to say. We deploy both our own balance sheet as well as blended solutions in two different ways. One at the transaction level, because there's always going to be individual deals. However, what we're looking to do more and more is work on platforms. And an example of a platform that we're unveiling here at COP actually is a platform called Gaia. And it's a $1.5 billion blended finance platform. We got approval in October from the Green Climate Fund for $150 million in first loss equity. So the $150 million is coming from the Green Climate Fund. We have another tranche of commercial insurance that's coming in. We have an interesting little sidecar facility that's dealing with FX, and we have technical assistance to do last mile project preparation. This is, well, thank you. It's a big deal. We're hoping that it'll be a blueprint, something that we can take and adapt to different markets, that other investors, other entities can also adapt and replicate as a blueprint for trying to mobilize private capital at scale. What's unique about this is there's 25 emerging markets, including 6 markets in Asia that the platform is focused on. It's not a fund, it's actually a platform. So FinDev Canada sits on all of the different committees, including the Investment Committee, the Impact Committee, the ENS Committee. We've developed this in partnership since day one with MUFG, who's the largest, as you may know, largest non-state-owned bank in the world. This was hatched at Glasgow, so 2 COPs ago. So it took 2 years to actually bring this thing to fruition. And we're super excited about it. It's focused on adaptation. 70% of the platform is focused on adaptation, 30% mitigation. So we're really trying to push forward and get private money into adaptation. Clients of the platform are focused on sovereigns, quasi-sovereigns, sub-sovereigns, PPPs, et cetera, et cetera. So some sovereign exposure. So we're getting private financing into borrowers that otherwise wouldn't be able to access the private sector. So it's a very traditional sort of, blended finance using first loss in some ways, but it's also innovative, again, that we're bringing in private insurance, that we're doing something innovative around Forex to see if we can deal with that issue, as well as having technical assistance. And the fact that we've done this in partnership from day one with the private sector, I think, is something really unique. So in addition to transactions, we'll always deploy blended finance in transactions, really looking to do more platforms and aggregation, as Kitty was just saying.
Thanks, and Gaia is a very substantial deal, not just in dollar value, but also in structure. It's really an interesting one for people to read. I can't remember what Gaia stands for, not to put you on the spot, but what is the abbreviation?
It's actually not an acronym. It's the Greek goddess of Earth.
So another woman. Okay, all right. So you've heard from the philanthropic side, a development bank, and now we're going to hear from the real money, as I like to call it. But seriously, most of the capital in the world that is available to take on climate change or any other development or investment opportunity is commercial money. And in the Asia region, commercial banks are a really large section of the economy, even more so than in other places. So I'm really thrilled to have Standard Chartered here. Not only that, but in our State of Blended Finance, we pointed out that Standard Chartered, if you look just at climate blended finance, stands 6th in our rankings behind folks like MUFG, the largest bank in the world that's doing Gaia. And overall in blended finance in the past few years, Standard Chartered is number 3, and it's beaten only by 2 impact investors. You can imagine impact investors showing up in blended finance, but among the commercial banks, they really rank high. So I want to ask Standard Chartered, what is it you're doing differently in-house? What's the culture that's making you stand up so frequently in the blended finance stats? Are you more active in early stages? You know, do you actually expend more energy creating transactions, or are you just working more closely with development banks than other banks? How is it that you're showing up so frequently in our data, and what is it that you know, draws you into the sphere of blended finance so frequently?
Great. Well, thanks for having me. I have to say I've already learned a lot from my fellow panelists. I'll answer your question just to kind of just touch on, you know, I love the fact that philanthropic capital is bringing in private capital. And I think when I look at all the philanthropic capital out there, I think if you know, a quarter of it could be used to unlock private capital, it would really make just a huge impact in the world. It creates discipline as well, and impact measurement is just so critical. And congratulations, I thought that was just an amazing platform that you've just announced. So to answer your question, look, I think StanChart as a kind of a base, we operate in 52 markets, many of them which benefit greatly from blended finance. And I think that's kind of a starting point, which is risk tolerance, which a few of us have spoken about. And you know, it's more than just being there in the markets. I think as an organization, we have patience, because some of these transactions take a long time. We are willing to spend that time. And I think part of that, I think, comes from the buy-in of our organization at the very top. Our CEO, our chairman, cares about blended finance, and they encourage our organization to work on blended finance, and also just really the passion of our RMs. We additionally are very close to many development finance institutions globally. And I think it's really important to take the time to understand the different pools of capital that are out there. They all, be it a DFI or an MDB, they all have slightly different requirements. And to the extent you can understand that and bring them in to partner early, I think that's also really key. The private sector will often say the public sector doesn't move fast enough. And I think partnering someone and understanding each other as early as possible, I think really can bridge that timing gap, which really helps accelerate private capital. You know, I think a few of us have touched on, and I think Kate mentioned too, this whole kind of individual deals versus platforms. And it's interesting because I think there has been a shift to this platform approach, which I really like to see. But one other thing just to bring in, and it'd be interesting to get your perspective, which is I think if we can also increase, what's the word I'm looking for, standardization, I think that would make a huge difference. And I think with respect to climate in particular, if we had, you know, very clear guidelines as to wind projects, solar projects, and what the private sector could bring, and how we could be supported either, you know, through concessionary capital or other types of, you know, guarantees or other types of blended finance instruments, that would enable us to move much more quickly and I think really unlock a lot of capital. So, you know, it's what I guess I would invite other private sector organizations who are thinking about increasing more of their blended finance, just to really think about your risk tolerance But don't just assume, because you don't operate in a certain jurisdiction, that you cannot do it. It's really just a matter of trying to understand that market, trying to partner with the right people, and see what the art of the possible is, and take the time to do it. And I think it really can create some tremendous unlocks.
Thanks. Your comment about philanthropic capital, bringing in private capital, reminds me, in our report, we point out that there is a very, very small supply of philanthropic capital going into climate blended finance. I forget the number, it was like $100 million in the past 3 years. Don't quote me on that, I'd have to go back to the report, but it's a very, very small volume. Philanthropic money hasn't habitually interacted with private sector investment money. It typically has gone in undiluted form into direct charity and not served to tee up private sector investment opportunities, partly because of the regulations that philanthropies operate under. They have to have a charitable purpose, and partly because there's a tendency to want to, I think, a tendency to want to see the outcome of your transaction. So if you give it something to a charity, you know that you get X number of people vaccinated or whatever. It's very hard to put your money into something that 2 years later turns into a commercial transaction and hope that everybody can see your impact. I think there's a slight cultural thing there too. Anyway, it's a very small volume. So having a philanthropic actor play in the energy access space like GAP does is a pretty new and exciting thing. So channeling the project developers who are not on this stage because our panelists dropped out, I am developing a single project, a renewables project or a water treatment project or something on the ground in a developing country with high ambient country risk. How do I get to the capital? And at the same time, I hear from institutional investors there's no project pipeline. So can we go back to that? So if I am operating at the I'm building something part of this, how do I get to any and all of you? What's the path? Adani, do you want to take the question on?
Sure, I'll start. I have a microphone. So how do you get to FinDev Canada? Well, yeah, look us up on the website and give us a call. So no, it's not quite, yeah, that sounds simple. No, but seriously, I mean, so we have smaller amounts of grant capital that we're able to support for last mile project preparation. Again, we also take risks, and take risks isn't only with our balance sheet, it's also taking risk with our administrative expenses. And so I'll give you an example in a different region, but in the Dominican Republic, which is a small island developing state, we leaned in quite heavily with a local developer of a solar farm who, well, it's not even a farm, it's a plot, a very small solar project, and we spent 18 months with them helping them as a developer coach develop this project so that we could then help them crowd in some additional private capital. So we do have some TA, technical assistance, that we bring, but we also have sweat equity that we bring into a transaction that we're able to do to help get it over the line. So that's how we work sort of with early development phase type projects, for example.
Yeah, I'll just say, look, I think technical assistance is really critical. It's so funny because I hear all the time the countries say there's not enough finance, and then you hear the MDBs say there's not enough projects, right? And so you hear it all the time. And I always sit there and I think, what's the disconnect, right? Why am I hearing a complete, two ends of the spectrum? And I think what it is an interpretation of what's bankable. And so from a country perspective, what I would say is, sometimes they say, we've got this great project. And I say, great, I'll fly there, I'll come meet you. And I sit there and I hear this great project. And what the country means from a great project is, it was just budgeted for and approved. That's not far enough for people like us, right? So this is where kind of technical assistance comes in. So I think bridging the gap to those of you in government, I would say, you need to take it a little bit further than it's been budgeted and approved when you reach out to a bank. Have the developer, have the project, have the 5-year projections, have it really ready to go, and then people like us can really, come in and bring the capital. And so I think it's bridging the gap of the point in time where we need to come together. So that's my observation.
So we do the technical assistance, project identification, as well as the project preparation. So, but from Joan's question, what I'm hearing is a bigger question, which is clearly there's a gap between supply and demand. So we're not talking to each other, and there's no existing avenue to make sure that conversation exists. So we as GM have boots on the ground in certain markets, and our people are actively sourcing deals. They were looking at what needs to happen and not happening yet, what wants to happen and doesn't have the means to happen. So if there are deals, projects, you're welcome to get in touch with our team.
Thank you. Let me take a moment and see if anybody has any questions building up as you sit there. And I will hand over one of our mics so that we can, please speak into the microphone because this is being live cast as well, and those who are not here.
Aloha, everybody. My name is Amanda Ellis from New Zealand, living in Hawaii. Just a fantastic panel. I worked as an economist at the World Bank and then ran the New Zealand Development Agency, so it's real music to my ears to see this kind of innovation happening. And I met Dana earlier today and used to run the World Bank President's Global Private Sector CEO Forum. So I just think it's fantastic to see this connectivity. I have 3 questions for you brilliant women. The first one is, given that the multilateral development banks bring political risk insurance, which can really be very helpful in an underwrite, how might that influence your partnerships with blended finance? Second of all, subsidies. We saw the IMF data that came out a couple of months ago, $7 trillion in explicit and implicit subsidies for fossil fuels. We talk about a policy environment, right? So how might you address that ridiculous policy disconnect? And then third, thinking about, oh, sorry, I should let other people. We know that we have to triple renewables. Lots of countries have said they're going to sign up and triple renewables by 2030. And we know there's all this money pledged from GFANZ, but it's not going anywhere. So how do we actually help with that tripling of renewable energy by 2030 as well? And you're all amazing. Thank you. We need to go to hear AJ Banga, so we're going to have to slide off. So I hope you can answer my question right away.
I'll take the first one, and then I'll pass it along, because we're probably the biggest users of political risk insurance up here. Political risk insurance, critical. Critical to unlocking our ability to give capital in the developing world. That being said, there are some limitations out there, as you're probably aware. Certain MDBs, and everyone's got their own constraints, but can't give this type of insurance if the credit rating of the country is too low. For instance, below BB minus or some constraints. So I guess, no, yes, well, so yes, depends on the organization. Yes, I see what you're talking from a government to government. Yes, I know you're talking about like a more of like a MEGA. So I would say, again, it kind of gets back to MDBs, DFIs, to the extent that they can think about potentially expanding their own risk tolerance as we are in this moment of time with the very deep need to act quickly. Having that additionality, having that additional unlock would be really critical. But a lot of what we do would not be possible without political risk insurance, absolutely.
And yeah, and maybe just picking up that very quickly, I think, MEGA isn't quite an unkept secret, is that the way you frame it? But it's an amazing secret. It could be unleashed in some of the conversations around the MDB reforms with some reform of the instruments and what have you. I think that MEGA could have a really incredibly more impact in market. So that's one thing, like yay for MEGA, got to do some good things with it, but I think it's awesome. Secondly, to answer to address part of your questions around like what do we need to unlock, one thing that I think is incredibly important is and you mentioned it, Kitty, about an ecosystem. It really is an ecosystem approach, right? Which includes host governments, MDBs and DFIs, donor governments, philanthropies. I can't underestimate the critical role of host governments, right? Have they created the goals, right? Do they have proper goals? Do they have the policy, regulatory, institutional environment to support the goals, but also to unlock private investment to actually, have investment flourish to help them achieve their goals. There's a lot in the conversation around private capital mobilization, if the private sector should do this and the private sector should go to that market and the private sector, if host governments don't, they're the only ones that can do that stuff, right? And to that end, that's where I think the role, particularly the multilateral development banks, are really important, because they have the sovereign relationships, right? Like DFIs, we don't necessarily go that far up the stream. We don't work on policy and regulatory framework, so happy to partner with other folks that do, including the MDBs. But if host governments aren't going to work on that stuff, then you can't put it all in the private sector and tell them, well, you should go into all of these markets. So it's absolutely critical that they get it right. And some of that stuff isn't sexy, right? It's macroeconomic stability, it's currency stability, it's creditor rights, it's all that kind of plain vanilla stuff that's absolutely critical to unleash the private sector. And to the extent that we do that, then I think private sector will flow. And I think that we also need to ensure that we're having a conversation of sort of making sure that we're friendly to unlocking capital, private capital, into middle-income countries, right? Because investors need to walk before they run, right? This is something that I've heard before. And getting folks into middle-income countries then will help unlock some more capital for lower-income countries. But it isn't necessarily going to be done all at once, perhaps. So looking at differentiated approaches using blended finance to address some of the lesser issues for middle-income countries and other issues. Well, if that $7 trillion were a country, it would have a seat at the G7, right? So, okay.
I'll take the policy question. Thank you for pointing out the elephant in the room, because there are trillions of dollars that need to go to the energy transition, but instead is funneling through the fossil fuel industry. So I think the challenge for renewable energy, to your third question of how to take that to the next level through 2030, is we need to create a level playing field. Right now, renewable energy and also fossil fuel, they're not competing on a level playing field. There's no same game rules, and there's not enough same kind of money going to both sides to really allow a competitive, a fair environment to really kind of compete in the same ground. So with that, I think it's important to also put all of ourselves in the shoes of hosting governments. So to your point earlier, what are they thinking about? What's stopping them? I think on one hand, they're very worried about who's going to pay for their development and how much they're going to pay for it. So reasonably, I hear a lot about, I think about how much I pay. I think about what's the cheapest source of energy. I think about the potential of my region, my country, still growing at a double digit that you don't see elsewhere in Southeast Asia. On the other hand, they do have decarbonization targets. They want to go net zero. They have that ambition. But when it comes to innovation, this is the time to innovate. This is the time to innovate around business model, around financing, around policy. But what are we helping to bring into this region to really increase the capacity for local policymakers so the countries can really step up, along with all of us who can step up in all of this? Thank you.
There's another question from the audience. Please go ahead.
Hi, my name is Gilberto. I'm part of the Amazon Investor Coalition. I wanted to ask about, how do you look at, when you're selecting the types of projects you're working at, what is going to be impactful long-term, but also profitable in terms of, generating more and more projects like that, but also innovation in those areas, especially around things like food, like taking meat and animals out of the agriculture, because that's, of course, in my case, the main reason why we're destroying the Amazon and burning it every day. So
the question is, how are the development actors or the commercial actors
how do you
on this
measure
stage
the impact, like when you're picking
balancing
the actual projects, the founders, the research, the enterprises, how are you looking at that particular impact?
Well, clearly any blended finance project that doesn't have a reliable revenue stream or prospects thereof is not going to work. So I'll start there. But do you want to, either of you, take that on? I'm not sure that you're in the food business per se, but...
I was in the food business before this. So I used to run Impossible Foods, one of the world's largest food tech and plant-based meat companies. So I feel what you're saying. I think there is a very important transition that needs to happen also in the food and agri space. And what we see in two systems transition, in energy transition as well in food and agri, have a lot in common. And there's a lot we can learn from each other. Very quickly to your question, there are a lot of frameworks. There's no shortage of measurement frameworks. We need to have less of a manipulation of data.
I feel that as a vegan, I feel the need to jump in on this one. Look, one of the ways that we're thinking about it, in terms of impact measurement is looking at deforestation, but also we are looking at taking an approach in terms of methane restrictions and running that through our portfolio, something that we're looking at this coming year as we also set our agricultural targets. So I'm very much, I should say, on behalf of Standard Chartered, we're very much thinking about that. I think it's quite critical.
And then maybe just very quickly from the DFI perspective, so we, like our peers, have a very rigorous and robust impact framework that we look at. We look through those three lenses that I mentioned in terms of what our impact goals are, and we manage, we have to, what doesn't get measured doesn't get managed, right? So we actually have before, during, and after indicators that we agree on and we measure and where we disclose, we're transparent about it.
Any last questions? We have two. Maybe we could have both of them, then I will hand it back to Kate to wrap up.
I joined late, sorry for that, but I appreciate the 2 points below one, the projects and fund equally used. I am from India, and we do have projects, and we have a very much partner with Australian agency. And your last point, the small holders, the farmers, your aim is really very, very successful. I just want to congratulate that whatever we are thinking at this forum is likely to be more, because that has a potential growth in both adapting to the climate change conditions, also growing food and enhancing the economy. So just I want to say that as a appreciation.
Thank you. And Leah, you had a question?
Thank you. Leah Peterson, part of the Convergence team. I have the pleasure to work with Joan and David. I heard innovation come up quite a bit in the conversation. That's often a loosely defined term, but fortunately it is coming up, and we place a lot of emphasis on innovation in our design funding and market acceleration portfolio. Curious about your considerations of creating more innovation in this space. How and to what degree do your organizations value it, especially in the value chain of blended finance, that very early stage, creating the platforms? What level of not just risk, but financing are you willing to put towards those type of innovations?
I like to think of myself as innovative, and I've tried a lot of interesting blended finance projects over the year, including one affectionately called the Rhino Bond with the World Bank. I could talk to you about the structure of that. It was quite different, with an outcome payment from the Global Environmental Facility tied to the growth rate of the rhino population. And yes, rhinos can be counted by an auditor. But I do struggle with innovation, because the problem with innovation is you're always innovating. And how do we get to scale? And so I've kind of come to the realization that I need to do both. So I need to innovate, and we need to innovate in so many different ways in terms of supporting technology as well, but we also need to figure out how to standardize or build these platforms so that we can scale that much faster. So I think to me, I think the answer is you have to do both.
So from where I sit in sort of the ecosystem, I would say I would agree with that. We got to do both, because sometimes, and it depends on, to your point, what's the definition of innovation? Because something that might be plain vanilla in a developed market, bring that into a really challenging market is innovative, because you're bringing investment into a really challenging market. So it depends on what your definition is. So I agree, you've got to do both.
I want to say two things. One is we have very nimble and precious capital, and that really allows us to innovate. In fact, our mandate is to innovate. So if you imagine everything you do has to be some form of innovation, then it's not an easy thing to do. However, I would say that with the kind of nimble gold dust that we have in the energy transition, one way of innovating on top of what the two panelists have talked about is partnership. It's an innovation of who we partner with, how we come in, and how we work together. And it's also an innovation of cross sectors. Now, I come from a different sector. The value I see is if we build a blended finance platform, for example, how can we innovate by bringing in that, what we created, into a different industry, different field, different geography?
Thank you very much, all three of you. I'm going to turn it over to Kate for wrap-up remarks.
No, turn it off. What a fabulous panel. Wasn't that inspiring? And really, some really exciting initiatives and a fabulous name for Goya. I love it. I guess my major takeouts from that were, really what it all boils down to is partnerships and innovative partnerships. I think this is something that I've really observed over the last couple of years. You know, we're probably most similar to a philanthropic in the fact that, you know, we have grant funds and, you know, they are grant, which means that, you know, 100% risk there, you're using it. So what does that mean for us as a donor? It means that we can take the risk and we can operate in that space. But, you know, even with that, there have been challenges in sort of overcoming that sort of mental hurdle about the fact that we're in that investment space as a public sector entity. But what was really clear through that is the platforms are definitely the way to go to try to get to scale, that there are different actors in the system and they all need to play to their advantage. And that includes the MDBs. They are actually very well placed to offer political risk insurance, to have those government-to-government conversations, and I've certainly relied on them to do that on occasion. Donors can also directly have those conversations, and I discussed that this morning. You know, we can work government-to-government on some of those issues as well, particularly around the policy reform space. So, you know, the challenge I think for us is that, you know, there are actors with different comparative advantages and, you know, it is actually talking to each other, understanding each other and the limitations that we have, and actually having those honest discussions about who's best placed to do what in order to take us to scale. So I think that's my major takeout from this. And just an absolutely wonderful panel. I'd like you to join me in thanking